Welcome to our channel. This channel deals with the fire journey of a family. Our net worth goal is $5 million. So this is our allocation goal in retirement. Bonds 20%, cash 5%, and stock market 75%. The reason for this is there are many studies and YouTube channels out there I won't bore you with, but this is where we feel comfortable in a long-term growth, but some rainy day funds in the form of cash and bonds.
And this is our current high-level portfolio breakdown. We are working on reducing some of the individual stocks and moving them towards bonds. And that's why you see the cash a little higher as we're purchasing bonds and rebalancing from stocks.
So this is how it looks now. At later time in the video, we'll go into the exact sort of cash and value, etc. But at a high level, as you can see, most of our budget, sort of so to speak, is as the 4K that's invested in S&P 500 mostly, and the rest is split up across stocks. And as we mentioned before, bonds is something we're actively working on. And there's a bunch of names there, but don't worry about it. We'll go into details in the later slides. So this is our stock portfolio. So these are individual stocks held in various accounts, Fidelity, Schwab, Vanguard, etc. So most of them are skewed towards tech stocks. It's because it's something we work in on a daily basis, and it's something we have some knowledge in. Again, I'm not advocating purchasing individual stocks. We purchased these a while back, and they've gone up significantly. The last 2 years, specifically tech stock, have been a boom. So I would just highlight one thing, Reddit there. Um, that's was that was bought $1,000, like, and Reddit has skyrocketed in the last year. It's not even a long-term gains. It kept porching it, but it some of these are just like, hey, nice to have, because we're working in like fund budget, but since they significantly like skyrocketed, yeah. Um, so as you can see, Google and Microsoft are very like skewed in this category. We're actively working towards like paying the capital gains on it, doing some tax loss harvesting towards the end of the year, and starting to move away from it. We are aware it's very unsustainable. We had a large portion in Meta a while back, and that stock crashed by what 80%. Um, so we've learned our lesson. Um, and we're trying to move away from individual stock. We don't purchase individual stocks just from our fund budget, but not like as an active sort of portfolio management. And just like taxes, basically. It's what's preventing us to like do an immediate step. It was like, oh, let's cash all the stocks out because there's significant gains in all of those. I would say probably 25% is the cost basis for most of these, and the rest is just growth. So a good problem to have. And these are our index or portfolios, or less risk, more diverse. Most of them are S&P 500 and total market funds. We're huge fans of the Fidelity. Their zero management fees on some of their indexes are very like welcoming to us. So we like those. And there's a few sort of like XLE, which is energy, which is what we use sort of like to hedge against gas prices. It's like if the cost of a tank is of gas is increasing, we'll know like we're paying for it, but we're also earning from it, so to speak. And vegan and all of those are more like beliefs and like let's invest in that industry and see it progress. And these are our bonds. So the bonds are very low risk or low boring, uh, lack of a better word. Gold, we consider part of bond. It's something that's very like stable. It won't crash overnight. Uh, and most of our bonds are being transitioned to be held as part of the U.S. Treasury, like their actual website, not via any brokerage. The reason for that is the rates are very good. We had a few index funds that like bonds index fund, BND, etc. All of those. We saw the rate of returns of them was not worth it. We invested in a few company type bonds and municipal bonds, but again, we saw like risk reward, it's not there. Like the 0.2%, just not worth it for us. Where we are, sort of like this close to retirement, we more want to preserve our capital. And so there's some limitations insurance wise, Fidelity, Schwab, all of those guys. Um, they're not like insured for the whole amount, especially in large amounts. They're insuring like a certain portion of it, and they're insuring against their own bankruptcy. So this is not the stock going to zero. This is more like the management company is going to zero. So that's why we move some of our things into U.S. Treasuries, like directly handled by the U.S. government. So that's covered by 100%. So if the U.S. government goes bankrupt, I think we'll all be in a lot more trouble. So we're okay with hedging our bets against their system. They have a crappy UI. It's very hard to do things and move things around. But for holding bonds, and we have two, three, we have some I bonds and some 10-year bonds and some 30-year bonds. So all around sort of like diverse sort of bonds portfolio. Some of it to adhere to the bucket strategy, some for delayed um, uh, taxes, that sort of thing. We also hold some bonds for our kids. These are not tracked here, the bonds for the kids, but we also, it's part of their portfolio, sort of like long-term stability.
And these are our unrealized gains. So it's something we started tracking. Again, for tax purposes, it paints a picture of where we need to focus and the tax implications of rebalancing things at this point.